The market's dropped another 10, 15% or more. The news is screaming about inflation, the interest rates, and global instability. And you're left wondering, is this the start of something worse? Should I be doing something right now? What if I lose everything that I've worked for? This can be a very stressful feeling, and you're not alone. But in my opinion, here's the truth. Panic is not a strategy. In those moments of extreme market volatility, what you don't do is often just as important as what you do. And that's why I want to share with you 4 grounded, practical steps that you can take when the markets feel anything but stable. But managing volatility isn't about predicting the future, it's about preparing for it. Hello, I'm Scott Norris. I'm an investment advisor with Royal Fund Management and the owner of Nexus Financial Group. Since 1999, I've helped individuals and couples nearing retirement build financial strategies that are designed to work in good markets and the tough ones. And I want you to know, I feel volatility isn't a reason to abandon your plan, it's a reason to revisit it, understand it, and make sure it's truly built to last. So whether you're retired, approaching retirement, or simply tired of feeling rattled every time the market dips, this video's for you. Stick with me as I walk through 4 steps that can help you stay calm, focused, and in control when the headlines are feeling overwhelming. Now, before we get started, make sure you like, subscribe, and comment below if you have any questions. I'd love to hear what you're thinking. So let's get started. Step 1, zoom out and remember the market's history. When you're watching your portfolio drop day after day, it can be easy to feel like things are spinning out of control. But that feeling often comes from zooming in too close, watching every tick of the stock market, reading every headline, and assuming today's chaos will last forever. So I recommend the first step in managing extreme volatility is to take a breath, zoom out. So let's talk about that market history for just a moment. The stock market has always gone through periods of turmoil, corrections, bear markets, recessions. None of these are new. What's important to understand is that historically, they've recovered 100% of the time. Here are a few quick facts to keep in mind. The average market correction, a drop of 10% or more, happens about every 1 to 2 years. A full bear market, that's a 20% drop or more. They tend to happen every 6 years. And yet over long periods, the market has consistently recovered and grown. Take the 2008 financial crisis. The S&P 500 dropped over 50% when it was at its peak. That was scary. But those who stayed invested and followed their plan saw that their portfolios recovered and eventually grew far beyond pre-crisis levels. Now think about March of 2020. The markets dropped more than 30% in just a matter of weeks due to the pandemic. But within months, the markets had bounced back faster than most people expected. So when we zoom out, we realize something critical. Volatility is temporary. Discipline is powerful. If your retirement strategy is built on long-term planning, not short-term speculation, then these temporary drops, they don't define your future. Step 2, know what you actually own and why. The second step is about clarity, because here is what often happens during volatility. Investors panic, not just because of the headlines, but because they don't fully understand what they own. They see their portfolio value drop and they wonder, is this supposed to happen? Should I sell before it gets worse? Am I in the wrong investments altogether? These are understandable questions, but they just usually stem from lack of understanding, not a lack of planning. So let me give you a framework that I use with my clients all the time. Every dollar in your portfolio should have a job. I ask, how much of your money do you want line in the sand safe, can't lose a dime? And how much of your money do you want at risk? Not lose all your money risk, but a risk that you're comfortable with. Think of your portfolio like a team. Some of your assets are your growth players. They're designed to take more risk in exchange for long-term growth. That might be your stocks or equities. Others are income players. They generate a reliable cash flow, bonds, dividend-paying stocks. And then you have safety players. These are your cash reserves or your short-term holdings. They're not there to grow. They're there to protect and stabilize. Now imagine that the market drops 20%. If you know that your growth assets are down, but your safety assets are intact, and you don't need to touch that growth bucket for several years, suddenly the urgency to sell just disappears. Understanding what you own and why you own it puts you back in control, and it replaces fear with clarity. This is one of the most powerful ways to stay grounded when the market gets turbulent. Step 3, focus on what you can control when the markets are volatile. Many people naturally feel helpless. You can't control the interest rates, you can't control inflation, you can't control geopolitical events or the Fed's announcements, but what you can control is your response, and more importantly, importantly, your strategy. So here are 4 areas where you still hold the steering wheel. Your cash reserves. You're retired or you're nearing retirement, and having a buffer of 6 to 12 months worth of your expenses in cash or stable assets can make a world of difference. It gives you time, the time to let the market recover, the time to avoid selling growth assets at a loss. Number 2, your withdrawal strategy. During a downturn, drawing income from the wrong part of your portfolio can lock in those losses. That's called sequence of return risk. Instead, consider pulling from more stable assets like short-term cash or bonds or cash equivalents until the market regains its footings. For example, if your equities are down but your bond holdings are stable, use those assets for your income right now and give your equities time to recover. Number 3, your asset allocation. Your mix of stocks to bonds and other holdings should reflect your risk tolerance and your retirement timeline, not what the mood of the market is. In fact, market drops can create an opportunity to rebalance, and that means selling some of what's held up well and buying what's temporarily down, bringing your allocation back in line without guessing timing. Number 4, your tax strategy. Yes, even taxes can work in your favor during a downturn. For instance, you might harvest losses to offset gains elsewhere, or consider Roth conversions while your asset values are low so that future growth can happen tax-free. All of this is possible because you're focusing on what you can influence. That is what I believe planning is really about. Staying proactive, not reactive. Step 4, stress test your retirement plan. The final step, and the one that's too often overlooked, is to put your plan through a stress test. Let me explain. Most people build a retirement plan around a smooth, steady rate of return. That's just not how the markets work. Returns don't just show straight up in a straight up line. So what could be a smart move is to run your plan through a worst case scenario. Ask yourself, what happens if we experience a bear market early in retirement? How would my income hold up during a 2 to 3 year downturn? What if inflation stays elevated longer than expected? A proper stress test can answer these questions before a crisis hits. And here's what I believe is real value. When you've seen how your plan performs under pressure, you don't panic when the pressure shows up. For example, let's say you're planning to withdraw $60,000 per year from your portfolio. A stress test can simulate what happens if the market drops 25% in 1 year. Does your plan hold up? Do you still have enough liquidity to ride it out? If the answer is yes, that could contribute to peace of mind that you cannot get from watching the news. If the answer is no, then you've just gained some critical insight while there's still time to adjust. Stress testing your plan doesn't just protect your portfolio, it can protect your confidence, and in volatile times, many people feel that that's just as important. Let's face it, extreme volatility can rattle even the most experienced investors, but it's typically not the downturn itself that determines your outcome. It's how you respond. So remember these 4 steps. Zoom out and regain your perspective. Know what you own and why. Control what you can control, and stress test your plans so you're prepared and not surprised. From my experience, if you do that, you're better equipped to navigate the ups and downs of the market without derailing your long-term goals. And that just might help you sleep better at night. If you're unsure how your retirement plan would hold up in a volatile market, or if you simply just want a second set of eyes, book a call with me using the link in the description below. I believe retirement is a process, not an event. It does not require guesswork. It requires a plan that is built to weather uncertainty and clarity and confidence. Thank you for watching, and if this has helped you, be sure to like, comment, and subscribe for a more clear, level-headed retirement guidance.